It's an eventful week this week with Election Day tomorrow. Then the Federal Reserve had to push its two-day FOMC meeting back. While there seems to be more consensus on the Fed's interest rate move this week, one question will be how the election could reshape the economic outlook and alter the Fed's interest rate path going forward. That's what Wall Street Journal chief economics correspondent Nick Timiraos writes in his latest piece. He is joining us now for more. Nick, it's great to see you. And obviously, we've been talking a lot about the election and about the Federal Reserve. It seems like consensus has coalesced around a quarter-point cut this week. But there are still a lot of questions about then what happens. What are you hearing about how the Fed is sort of attacking that issue?
Well, if you go back to their last meeting where they had to submit their dot plot, these are their interest rate projections. The September projections are interesting, right? Because they're basically telling you what they see as the most likely course for the last two meetings of the year. This is a calendar-based projection. And there was a pretty even split at the last meeting over whether you would have one or two more cuts this year at those two remaining meetings. There was a narrow majority that had two. I don't think a whole lot has changed since the last meeting, but the data could change between now and the next meeting. So I think it's very hard to say definitively that you're going to cut again in December. You can't rule it out. And I think there are plenty of wild cards. To me, the bigger question really, and it can't get answered at this meeting, is what do they do next year? Because the projections have the interest rate coming down to the mid 3% range next year. But I think there are scenarios in which they don't go all the way down there. And there are scenarios, of course, a weaker economy where maybe you do more. And so the data will decide.
You, Nick, in your column, you kind of pointed out, too, though, our central bankers have these sort of these interesting contradictions to think through, specifically job market slowing, but consumer spending hanging in there, Nick.
Yeah, and it feels like there's gravity that has to work on one of these, right? Either consumer spending is strong enough to prevent the kind of weakness in the labor market that people were worrying about 2 months ago when the Fed did cut interest rates by 50 basis points, or the labor market slowing continues. And last week's report was sort of a hairball. It's a little bit, you can kind of see in that whatever you want to. But, if the labor market keeps slowing down, you have to wonder, is consumer spending going to continue to be so resilient, right? So I think that is the puzzle for the Fed. It hasn't been resolved. If you were concerned about the labor market at the last meeting, you're maybe a little bit less concerned now, but not a lot less concerned. And if you thought inflation wasn't fully defeated and you had to be vigilant there, the last inflation report probably said, okay, that's still the right place to be. There's been a lot of improvement from a year ago. But the path ahead, you can't be completely convinced that you're going to come into 2%. We're no longer talking about sticky inflation above 3%. So that is progress.
Nick, one of perhaps the other puzzles or conundrums for the Fed has been what's been happening in the bond market, because they've been cutting, but yields have been moving up. How much of a problem is that for them if they are trying to, loosen up things here?
Well, if it's being driven by solid economic growth, I don't think that's a problem for the Fed. I think at the last meeting, you saw the market maybe getting a little bit ahead of itself, pricing in a lot more cuts than the Fed was likely to deliver under a soft landing scenario. And so you could argue that what's actually being priced in now is more consistent with a soft landing. You're taking some of the recession risk premium out of the market pricing, at least of the next 18 months or so. And then, there are a lot of people speculating about a Trump trade, concerns about higher deficits and Treasury supply. And, I don't have a good handle on that. But the election results should be known, if not in the next couple of days, then fairly soon. And so by the time the Fed meets again in December, you should have at least a little bit cleaner read on some of the politics and some of the political concerns that might have been driving that sell-off.
And you note, Nick, sort of just another interesting wrinkle for the meeting this week. As you point out, our central bankers would probably like to avoid the spotlight given the timing with the election.
Yeah, and I think that's exactly right. Jay Powell is going to do his best to just, not draw the spotlight at this meeting. The September meeting was more exciting than usual. Will they do 25? Will they do 50? How are they going to explain this? And, this week we don't have any interest rate projections. We'll have a press conference. I think Chair Powell is going to try to be as boring as possible. This isn't a week where the Fed really wants to be in the limelight. They never really want to be in the limelight, but sometimes it's easier to avoid the limelight. And this would be one of those weeks. I still think the big question is, what is the Fed's destination when these interest rate cuts are all done? And you have a lot right now that just makes it harder to answer that question. What happens after the election? Are there big policy changes? What happens with the next payroll report? We're going to get that next payroll report right before the blackout period on the December FOMC meeting. And so I think, even though there's not a ton of data before the next meeting, there could be enough to sort of help clarify the next move or two.
As boring as possible, Julie. That's what we're looking for. Set the DVR. Nick, thank you as always for joining the show. Love having you.
Thanks for having me.